What's going on, everybody? Welcome back to another video. Hope you're doing well, feeling great and enjoying freedom. It's a great day to have a great day. Today I want to talk about how a market crash is coming and why you shouldn't necessarily wait for it. Now, I don't have an exact date of when a crash is going to occur, but I do have a pretty good idea of when we are going to be seeing some really weak returns in the near future and how to make the most of it. We're going to get into it, but really quick, just in case you're new, make sure to subscribe for a bunch of videos. Subscribe to my second channel, which is my backup channel for exclusive bonus content. Get yourself some DYDSS merchandise to help support the channel. Try out some G Fuel energy formula, $5 off your first order by clicking the link in the description. And of course, make sure to go and get your up to 12 free fractional shares by downloading Webull and funding your account. They have a promo going on right now where if you activate it, it's going to set a 48-hour timer. And if you refer one friend to the app in those 48 hours, they're going to give you 18 free bonus stocks for the referral. Webull link in the description. Everything will be linked in the description. All right, so today I want to talk about the market crash, the coming market crash. I want to talk about bear markets. I want to talk about weak returns in the near future and how it could open up some major buying opportunities if you're interested in buying the dip. Now, as always, or as usual, my video isn't going to be necessarily something to watch, but rather something to listen to. Treat it like a radio show. Treat it like a podcast. All right, so I want to talk about something that happened a little over 3 years ago, and then fast forward back to present day and talk about returns. The difference in investing your entire life savings, or any amount of currency, the day before the market crashed, or the week before, right before the market crash of 2020. If you invested a certain amount of money in the market, broad market index funds, right before the crash, right before everything came tumbling down, and then you waited till present day, fast forward to present day, right before the crash, after everything got obliterated and built itself back up all the way to present day, you would currently be up about 25%. Just about. Maybe a little bit more, maybe a little bit less, but investing all those dollars right before the crash of 2020, fast forward to mid-2023, you'd be up about 25%. But what if you waited another couple of days? Or the following week or so, and you invested all of those dollars right as soon as everything crashed, near the bottom or at the bottom of the crash of 2020, and fast forward to present day, fast forward to from the crash of 2020 to mid-2023, you'd be up about roughly approximately 48%. Pretty big difference between seeing a 25% return and a 48% return. Massive difference between the two, but there's something similar between the two as well. They both returned a significant amount of money. One, a significant amount more money, but they both investors, the person who invested right before the crash and the person who invested as soon as it crashed, they both saw tremendous returns. The point I wanted to make right here, right now, is that you shouldn't wait for a market crash. You should, if you are investing, you should be investing on a regular, consistent basis, regardless of what the market is doing. Regardless of if we're moving sideways, or if we're up this week, if we're down this week. Doesn't matter if we're in the green, doesn't matter if we're in the red, doesn't matter if we're in the purple, whatever that means. The rock-solid investor invests regardless of what the market is doing because he or she knows that the long run will win. He or she knows that regular, consistent investing over a prolonged period of time wins. Dollar cost averaging your way into the market, however often you choose to do so. Maybe it's every day, a little teeny tiny bit every day. Maybe it's a weekly investment or contribution. Maybe it's monthly. Maybe it's quarterly or whatever. That beats trying to time the market. Time in the market is the most overrated investing quote out there. Time in the market beats timing the market. Because there's no real way to time the market other than to sit around waiting and waiting and waiting and allowing all this time to go past, waiting to make the investment. Because what are you doing while you're waiting to make the investment? And maybe you do get it right. Maybe you sit around with all those dollars for God knows how long, weeks, months, years, waiting for there to be a market crash. And then there's finally a market crash, and then you dive in. What did you do in the meantime? You invested weeks, months, years to waiting, getting absolutely nothing done. We're sure you waited for the right opportunity and you jumped in, and maybe it paid off, maybe it's going to pay off, but you let all that time go by. What if you sat around waiting and waiting and waiting? What if you put the weeks, the months, the years in and still no crash? And you just sacrificed all of those gains that you could have been seeing in the process. Like, what if you're sitting around, oh, it'll go down eventually. You know, you have this big long beard. You're sitting there like an ancient relic, still waiting for a crash. Oh, we'll see a price drop eventually. Meanwhile, the market's up friggin' 300% from when you decided to start waiting, and then all of a sudden there's a little bit of a decline. Yes, 10% drop, I'm jumping in. When you could have gotten 300% off by investing in the first place. I'm using extreme examples, but this is what a lot of people do. It's a mistake that a lot of people make. They wait and wait and wait and wait and wait, and we're going up and up and up and up and up and up and up. You know, let's just say there's a $75 stock that they want to buy, or let's call it an index fund. Let's just say it's $75. And they're like, $75, it's fair priced, it's fair valued, but I want to get it when it's undervalued. I'm gonna wait. Now's a good time to buy. Now is when I should be buying. But if I wait for that $75 stock or index fund to fall down to $65, then it'll be buying time. Then it'll be undervalued. Then I'll be getting a better bang for my buck. Meanwhile, time goes by. The $75 stock goes to $80, then $85, then $90, then $95, and then it's just about to hit $100, and it falls all the way back down to $84. Oh my God, it went from almost $100 down to $84. Now they buy in because the big giant price drop, big red alert price drop, $84, when you neglected buying it at $75. So point being is that you shouldn't wait for a market crash. You shouldn't wait. Sit around waiting, investing your time, and just sitting around waiting. What you should be doing is investing on a regular, consistent basis. And if you want to set aside a little bit of cash and keep a little bit of cash to the side in preparation for a market crash, or for there to be a correction or a pullback or whatever, sure, nothing wrong with that. But don't sacrifice the regular gains because you're greedy and you want massive gains. We all want massive gains, which is why you should have some cash on the sidelines. You should be sitting on some cash in preparation. That way you can buy the dip. You're buying in on a regular basis, but then during a price drop, a significant price drop, you can buy in a little bit more. See, that's what I believe what it's all about. That's what I believe is the right move. I believe that it's not necessarily a matter of buying low and selling high. For me personally, it's more a matter of buying now and selling never, and buying a little bit extra on the dip. That's what I believe is the right move. That's what I've been doing for a couple of years now, and I do not have a tremendous amount of time in the market. I have been in since the tail end of 2019, and I spent my first 6 months really just trying to familiarize myself with the market. Wasn't investing very much. I was just dabbling here and there and trying to just trying to learn. A little bit of trial and error, quite a bit of research. And by the time I was educated enough to start making a little bit more aggressive investments, boom, crash of 2020 happened. I was not sitting around waiting for the crash of 2020 to occur. That's just when it happened. And that's when I dove in a little bit extra, because I was holding on to some cash, preparing myself and familiarizing myself with the market, trying to become as educated and knowledgeable as possible so that I could make the fewest mistakes. That's how I went about doing it when I first got started. So point being, before we move on to when I am personally expecting very weak returns in the near future, by the way, not necessarily a market crash, which, by the way, a market crash is typically a 10% or more drop in prices across the board when it comes to the major indexes, S&P, Dow Jones, NASDAQ. If you see a 10% decline or more in a very quick period of time, that's typically considered a market crash, which could trigger a bear market, which means a 20% fall from recent highs. So you see a crash first, and you can rebound. You could rebound quickly. You can lose, 10, 12% and then bounce back up 10, 12% over the next couple of weeks, sure. But it could bottom out and keep on falling. Maybe not keep on crashing. Maybe it crashes, it hits the floor, and then it keeps on sinking a little bit lower, and maybe 3, 4, 5 months go by and you're down, roughly 20% from recent highs. That's what a bear market is. That's what it means to be in a bear market. Market crash is a 10% or more very fast drop. A bear market is 20% or more over an extended period, or over a short period of time, or an extended period of time from recent highs. So that's the difference between the two. One leads to the other. So moving away from that, moving away from why you shouldn't necessarily sit around waiting for there to be a market crash, because when will the next market crash be? Nobody knows. I don't know. You don't know. He, she, they don't know. Even the big top dog investors don't know. Is insider trading a real thing? Yes. Do the highest of the high level people have access to information before we do? Yes. But nobody knows exactly when a market crash is going to happen. Nobody knows exactly what a market crash is going to look like. Nobody knows the intricate details, or what the ripple effect, or if there even will be a ripple effect. Maybe it'll be boom, drop in prices, then right back up. Maybe it'll be boom, drop in prices, and we stay right there. Maybe it'll be boom, drop in prices, and then prices keep on dropping. No one knows the little intricate details. Especially not the average Joe. Especially not people like me and people like you. Which is why it's best to invest on a regular, consistent basis with a little bit of cash on the sidelines. And if you see prices drop, you can buy the dip with that cash. That's why I believe it's best to not sit around waiting for a market crash. Now, moving away from that, I want to talk about when I'm personally expecting, and I'm very confident that we will see prices drop in the very near future. This September of 2023, I don't know for sure, but I have a very, very strong feeling we will see prices lower. I believe we are going to see very, very weak returns in September. And I believe some major buying opportunities will present themselves this September of 2023. Now, why do I believe this? It's called the September effect. This is what we see almost every September. Not every single September. Some years we have an exception. This year we could potentially have an exception, although more often than not, September is just notorious for very, very weak returns. It's for a variety of different reasons. Change in consumer behavior, moving out of the third quarter of the year and into the fourth quarter of the year, the final quarter of the year, where investors start preparing themselves for, oh, you know, it's almost the end of the year, time to, you know, change our strategies so that taxes aren't an issue. Massive corporations start doing more spending here, less spending there, preparing themselves for not just quarterly earnings reports, but the annual earnings report. Just a change. A lot of things change. A lot of things change as we leave summer and move into the fall. And that's not even everything. Those are just a couple of examples of why September typically, almost always, leads to the notorious weak returns that month. So 2 years ago, we had the September effect of 2021. And halfway through the month, I remember thinking to myself, man, I had heard about the September effect. I didn't prepare myself for it. I should have been sitting on more cash so I could have taken advantage of this. And I remember I said in the VIP club, which, by the way, the VIP club, that's just the name of my Patreon page. If you want access to every single video I've ever posted, no YouTube commercials, none of that. And you can watch all of my new videos early, like 4 o'clock in the morning, 4 a.m. Eastern Standard Time is when I post them. Every single time I have a video to post, it gets posted at 4 a.m. Eastern Standard Time, so you get access to all the videos early and commercial free. All right there in the VIP club, link in the description. But if you're in the VIP club, you'll know. Because I used to do like live streams like twice a week over there, and I was always saying, or I was saying at that time, I was like, man, I'm kicking myself for letting this slip my mind. I knew about the September effect, and here we are in September. It slipped my mind. I didn't prepare myself for it. I did not go cash heavy prior to September, and now I don't get to make the most of, you know, these lower prices right now. And I said in the VIP club, next year, next August, or next July and August, I'm going to be extra frugal and just keep some cash on the sidelines in preparation for the September effect of 2022, the following year. And that's exactly what I did. Middle of July of last year, not only did I go a little bit more frugal than I would ordinarily be, and I'm pretty frugal to begin with, tried saving a little bit extra money, but I also applied for a secondary job. I was like, not only am I going to save a little bit of extra money, but I'm going to go make a little bit more money as well. So I saved all my paychecks, 100% of my paycheck, every week for about 4 to 6 weeks. I think it was the very end of July, or no, I'm sorry, the very beginning of August. August 10th was my actual date of hire. I applied at the very end of July, and I got started August 10th. So I spent the rest of August, the rest of that month, not only saving as much money as I could, but now I was making an additional paycheck every single week. And I was saving 100% of it and just holding on to it in preparation for the September effect of 2022. I didn't know for sure if we were going to get one or not. Like I said, it's not the greatest idea to try to time the market, but if there's a notorious month where almost every single year we see the same thing, poor returns, a lot of red, far more red than green, you know, 3 or 4 red days a week and only 1, maybe 2 green days per week, almost every single September, I figured it was a pretty safe bet. It's only, you know, I was only saving up for, you know, a month and a half in preparation for this 1 month. It's not like I was like, hey, you know what, I'm going to take a complete and total break from the stock market and sit around waiting for an eventual crash. No. I just started preparing myself maybe 6 weeks in advance for this one particular month. And if I'm wrong, so be it. I sacrificed what? 6 weeks? I didn't sit around waiting for, you know, years to go by for an eventual crash. No. And I kept on investing the whole way through, by the way. I still kept on investing. I just maybe I lowered my contributions a little bit so I can hold on to a little bit extra cash. And then anyway, lo and behold, September of 2022 hit. This was September of last year. And guess what we saw? We saw a month that was like, we spent like 80% of the month in the red or something like that. I remember there were certain weeks of September of last year where we saw nothing but red. Geez, that squirrel just fell out of a tree. Where we saw, see, that squirrel is just representing what the market might do this September. Just completely crash and just break a tree branch and hit the ground. No, but here's the thing. There were several weeks, or at least 1 or 2 weeks last September where all 5 days, Monday, Tuesday, Wednesday, Thursday, Friday, all in the red. Just a whole straight week of a decline. And then the following week was very similar. You know, it was another, you know, 3, 4, potentially 5 days of even more red. That's what we saw last year in September. Now here we are, as I'm filming this video, mid-July. By the time this video comes out, it'll be toward the end of July. Am I preparing myself for the September effect of this year? Once again, I don't know, I can't say with the utmost confidence that we will absolutely, without a doubt, see the September effect this year, like we do most years, almost every year. Doesn't mean we're going to get one this year. I'm personally leaning towards yes. I'm personally leaning towards that we will see the September effect this year. And you better believe that I'm hoping we see the September effect this year, because I'm preparing myself, and I will explain how I'm doing so in just one moment. I just wanted to use the next 10 seconds to remind everybody to make sure you download Webull and fund your account. Upon doing so, they're going to give you up to 12 free fractional shares. You can deposit as little as you'd like, even as little as a penny. It still works, it still counts, you still get your up to 12 free fractional shares. And they got a promo going on right now where if you activate it, just click the little activate button, they're going to give you 48 hours to make one referral. One person that you know. And they're going to give you 18 free stocks just for doing so. It's part of their advertising budget. Rather than wasting currency on billboards and TV commercials, they reward the user for helping them build their app with them. So make sure to download Webull, fund your account, and refer one friend. In the next 48 hours, you're going to get a bunch of free stocks, which you can keep and hold on to, or you can sell and use the cash to buy what you'd rather have instead. Webull link in the description. All right, so how am I preparing myself for the September effect? One thing that I started doing this year, or one thing that I started a couple weeks ago, normally for the last maybe 2.5 years, I've been making daily contributions into 2 index funds. And for this year, this entire year so far, I've been making weekly contributions to my Roth IRA, which, by the way, you can also open up a Roth IRA on Webull if that's what you want, link in the description. But I've been making daily contributions into just a regular account, like how I just said on Webull, just a normal investing account. It's not a tax advantage retirement account, just a normal account. You could buy and trade and sell stocks right there in the... I have an account, and every single day, Monday through Friday, as long as the market's open, I make 2 daily contributions into 2 index funds. That's what I've been doing for over 2 years at this point. Well, this year, I'm still doing it, but I cut those contributions in half. I'm making half the daily contributions. And I've been doing this since maybe mid-June, maybe about a month. I'm still making the daily contributions because, like I said, time in the market beats timing the market. I'm not going to stop making contributions and wait for something that may or may not happen, but I'm still letting those contributions do their thing every single day as long as the market's open. But I reduce those contributions so that I can keep the other half of those daily contributions just in cash on the sidelines. Not only that, I'm not buying any individual stocks at this point. I haven't. I am receiving dividends, which I am currently not reinvesting. I'm just keeping those as cash. And I've also been making a weekly contribution to my high yield savings account, which will at some point in the future no longer be a high yield savings account. Rates will eventually get cut. Rates will eventually decline. But I have cash sitting over there as well. So if we see a September effect this year, which I personally, I believe that we will. I'm not a psychic, so I don't know for sure, but I believe that we will. If I'm correct, I will have extra cash that I've been holding on to and stockpiling since June. So the second half of June, the entire month of July, will be the entire month of August. Moving into September, I'll have like 2.5 months worth of saved up currency that I can use to buy in if I'm right and if we see weak returns this September. And guess what happens if I'm wrong? I'll invest the dollars anyway and still see gains several decades into the future. If I'm wrong, what did I sacrifice? What did I jeopardize? A couple weeks? 6, 8, 10 weeks or whatever, where I still continued to invest anyway in preparation for me being wrong, while keeping a little bit of cash on the sidelines in preparation of me being right. And even if I just kept all of my cash, even if I just said, hey, you know what, I'm going to cut everything. I'm not going to make daily contributions to my regular account. I'm not going to make weekly contributions to my Roth IRA. I'm going to hold on to every penny for the next 6 to 10 weeks or whatever. Even if I did that and ended up being wrong, what did I lose? 2.5 months? Who cares? If I were wrong in that situation, who cares? Barely any time went by. Like I said earlier in the video, I believe it's a mistake to sit around for like weeks, months, years and years and years, waiting and waiting and waiting and waiting for something that may or may not happen, or something that will at some point in the future happen, and then you sacrifice all the gains that you could have been seeing in the process. Spending the second half of the summer holding on to a little bit of cash in preparation for an almost yearly September effect, I think that's vastly different. That's not necessarily trying to time the market. It's not trying to be a psychic. It's trying to capitalize on something that we see almost every single year. That, I believe, is very, very different. I don't think that's timing the market. But anyway, that's how I'm preparing myself for the notorious September effect. Something that we see almost every single year. Now, funny enough, I opened up my very first investing account in September of 2019. And I'm just thinking about this for the first time ever. I wonder what the September effect of 2019 looked like. I have no idea. I didn't even know the September effect was even a thing. That's just the month that I happened to open up my first account. Shout out to my friend Rob, who, by the way, might be either the co-host or just simply a reoccurring guest on a podcast that I want to get started in the VIP club. So there's another perk right there. I've been talking about it for years. I've been wanting to do it for years. I haven't had the time to do it. I still don't have the time to do it. But now that I got transferred to this new job, got this new promotion, got sent further away than I expected, when I leave work, he's on the way home. I stop by almost every week. And he's like me. big into finance. So imagine a finance podcast where we talk about all things money. We talk about different investing strategies. We talk about angel investing. We talk about the stock market. Maybe even we talk about real estate or precious metals or business, brand building, sales, marketing, just all of that. Entrepreneurship. That's what my podcast will be. Now, I don't know, at this time, he's more than likely going to be a reoccurring guest, but who knows, at some point in the future, he might just end up being the co-host of the show. So anyway, shout out to him. He's the reason I downloaded my very first investing app in the first place. He's the one that introduced me to the stock market. He's the one that gave me some pointers at the very beginning. He's the one that kind of showed me the ropes, and then I ended up going in a very different direction. He's more of a tech-heavy investor, and he's gone all in on a small number of individual stocks, and it ended up working out very, very tremendously well for him. I took a little bit different of an approach. I went more of the blue chip route, more of a dividend income investor, and now trying to make broad market index funds the backbone or the foundation of my entire portfolio. So we went in different directions, which I think would make for a fantastic conversation via podcast. So if that's something that you're interested in, that's something that I will hopefully in the near future be doing within the VIP club. Link in the description. All right, so the September effect of 2023. Will we see it? I personally don't know for sure. I can't say with the utmost conviction, yes, we will absolutely, without a doubt, we will 100% see it. I don't know. I personally believe that we will. And I'm confident enough to have been setting aside cash for, at this point, the last, month and a half. And by the time September rolls around, it'll be 2.5 months. I'm confident enough to have been doing that. I'm confident enough to have lowered my daily contributions into the 2 index funds that I am quite fond of. I'm confident enough to keep cash in my high yield savings account, which, by the way, I wasn't putting cash in the high yield savings account in preparation for the September effect. But now that I'm making this video, I'm realizing, I was like, hey, that's something I can use the currency for if we see a solid September effect. That's absolutely something I can do. I've made, I think, 3 videos at this point talking about how my high yield savings account bumped up the interest rate, which means it's kind of like an interest income pay raise. And I was keeping this account open without knowing exactly what I want to do with it. I was like, do I want to use it for when my CD account hits its maturity date and I use the savings account to roll over into a new CD account? Do I want to just let it keep, earning interest income until rates get slashed and then pull it all out and throw it into the S&P? Like, what do I want to do? I'm not exactly sure. But now that I'm thinking about it, I could, if I wanted to, use the currency that I've been making weekly contributions to the savings account, high yield savings account, over 4%, 4.15% at this point. I can take all of it or some of it, a portion of it, and use it to jump into the market this September, if I'm right and we see the September effect. There's so many different ways we can go. There's so many different strategies. There are so many different options. And I personally, I'm confident that we're going to see weak returns this September. I think we're going to see far more red than green. Now, obviously, it's too early to make any conclusive statements. As I'm filming this, it's mid-July. We have another, at the time I'm recording this video, 2 months or a month and a half before we even touch September. You can't say in July, oh, we're going to see weak returns or we're going to see tremendous gains in 6 weeks. Can't say that. We don't know. None of us know. So many things can happen in 6 weeks. So many things can happen in 6 days. Look what's happened to the stock market over the last couple of years. So much can happen in 6 hours. Jerome Powell can speak for 6 minutes and cause the entire market to flip upside down. So much can happen in a short period of time. And 6 weeks until we hit September, like a lifetime when it comes to the stock market. But like I said, I'm confident we're going to see weak returns. I think we're going to see far more red than green, and I'm fully prepared to buy the dip. I'm fully prepared to bump up my daily contributions back to where they should be, or maybe even higher. Like I said, I've been making a certain type of daily contribution every single day for the last couple of years. The last couple of weeks, I cut those contributions in half. Maybe I'll bump them back up to where they should be if we see the September effect, or who knows, maybe I'll even do more. I don't know. That's what I'm saving my dividends for. I will reinvest those dividends all in September. I have more cash on the sidelines because I haven't been spending in other areas. I've been extra frugal. All for the sake of the September effect, which we may or may not even see. And like I said, if I'm wrong, who cares? Nothing bad happens. If I'm wrong, I'll just invest the dollars anyway. What did I lose out on? A couple weeks? When I'm in this for the next, 20 to 40 years? What do I care? But that's just my game plan. It's just something that I do in September, and it's only because we see this almost every single September. If I do this every single year, I will probably get it right far, far, far more often than I get it wrong. And like I said, it's not really something that I classify as timing the market, because it's something that we see almost every single year. It's not something that we see every 5 to 10 years in a random month. It could happen at any time. It could happen super frequently. It can happen more no, this is something. September, very specific month. It happens almost annually. I think that's a little bit different, but anyway, it doesn't matter. Whether it's timing the market or not, it's not something that I consider timing the market. It's just something that I'm preparing myself for. It's just an investing strategy. I haven't touched my weekly Roth IRA contributions. I'm still making those as usual. I'm on track to maxing out the Roth for the year. And I also just technically got a pay raise. Well, a promotion that came with a pay raise and a 5% 401k company match. So I'll be making the most of that. So now, earning a little bit more money every week than I was a couple weeks ago, mixed with not spending on anything miscellaneous, mixed with cutting my daily contributions in half so I can save the other half as cash, mixed with holding on to a high yield savings account for this whole year so far, mixed with, I would say, the probably close to 80% chance that we see a September effect this year. Anyway, long story short, that's what I'm doing. That's why I'm doing it. That's how I'm doing it. And that's what my, my goals and my plans are moving forward. But it's not something that I do on a regular basis. It's not something that I don't, hold on to a tremendous amount of cash in preparation. Oh, there might be a market crash sometime in the next 5 years. I'm going to hold on to it. No, I don't wait for market crashes. I don't believe that's the right move. I don't believe that's an intelligent move. I don't think that's something that an educated investor would do. I don't think an educated investor would sit around holding on to cash, losing the fight to inflation, with their fingers crossed, hoping to get a better deal. What are you waiting for? Oh, I'm waiting for a 5% decline. Meanwhile, you don't even get that 5% decline, and you're losing the fight to inflation. See, that's why I don't think an educated investor would do that. I think a foolish investor would do that. Sit around waiting for, years potentially for a 10% drop. Meanwhile, we're up 30% from where we were when they decided to wait. Anyway, that's what I'm doing. That's why I'm doing it. That's how I'm doing it. It's how I'm preparing myself, what I'm preparing myself for, why I'm preparing myself for it. And it's just my own personal strategy. I think it's fun. If I'm right, it's a major win. If I'm wrong, It's a smaller win. It's a win either way, because only a small window of time was going by. I don't think sitting on cash for a prolonged period of time is a very wise decision. Because if you're sitting on cash waiting to make an investment, you want to know what you're actually investing in. Number one, you're investing your time, which is your most valuable asset. But by holding on to nothing but cash, you're investing in cash. And that's a losing game. You're guaranteed to see a loss, thanks to inflation, which isn't a problem if you're investing in the proper way. You want to know what the proper way is? Probably broad market index funds, which see an average annual rate of return of 8% adjusted for inflation with dividends reinvested. Average annual rate of return, 8%. You're going to have some years that are much higher. You're going to have some years that are lower. You're going to have some years that you're in the red. It all averages out to about 8%. Actually, it averages out to about 10 or 11%, but if you adjust it for inflation, about 8%. Rather than a normal year with normal inflation where you're seeing a loss of 2 to 2.5% because of inflation. Or the last year and a half with higher inflation. 7%, 8%, 9%. Right now we're down to, 3, 4%, which is still higher than where it should be. But even normal inflation, 2, 2.5%, you're losing 2 to 2.5% every year if you're all in on cash. That's a bad investment. That's a bad decision. That's being financially irresponsible. But if you invest in broad market index funds, you see an average annual rate of return of 8%. That's the winning strategy. You're going to have some good years, you're going to have some bad years, you're going to have some amazing years, you're going to have some terrible years, but it averages out to 8%, rather than having a guaranteed loss of at least 2 to 2.5%. If you don't understand that, it's because you don't want to understand it. That's what it comes down to. So in conclusion here, will we see a market crash? Yes, we absolutely will. When will it be? No idea. No clue. And anybody that claims to have a clue has no idea what they're talking about. There are the same people come out of the woodwork every single year. Oh, the market's going to crash next. At the end of every year, they say, oh, the market's going to crash in the new year. In the next 6 to 12 months. They say this every November, every December. Oh, it's going to crash next year. I swear to God, it's going to crash this year. And the entire year goes by and we saw nothing but green. They're like, oh, well, yeah, next year. The goalpost people. And guess what? If you say it every year, 5 years go by, 6 years go by, 7 years go by, and you're wrong every single year, eventually there's going to be a market crash. And you're like, I predicted it. See, I told you. I'm smart. Told you I'm smart. This is why you should listen to me and buy my courses online. Bah, 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 bah. That's what people do every single year. The end of every year, oh, the market's going to crash next year. Oh, watch out. Oh, no, big changes in the new year. This is going to happen. This is going to happen next year. Oh, the end of 2023, you're going to see a whole bunch of videos of these airheads talking about, oh, the market's going to crash in 2024. Guess what's going to happen in 2024? They're going to be posting a video talking about how the market's going to crash in 2025. Same idiots. Anybody that does this, ignore them. Disregard them. Eliminate them from your subscription feed. Those are not the people to be listening to. Those are fear-mongerers trying to prey on people that are trying to improve their financial well-being. They're trying to scare people into buying something from them. They're trying to scare people into all this stuff. There are people that do it even with the silver and gold. I'm not going to, name any names, but, it's one of the greatest lies ever told. Where they'll talk about how, all these, terrible, horrible things. Doomsday! We're all gonna die tomorrow if you don't stack silver. Hey, buy my silver. That's weird. If silver's the only way to survive, why are you trying to get rid of all your silver for cash? Huh. Makes you wonder. Ignore people like that. Disregard people like that. They are liars. They have no idea what's happening. They have no idea what's coming. None of us do. Which is why it's best to dollar cost average your way in. If you're more focused on silver and gold right now, that's fine. Dollar cost average your way into that. If you're focused on building wealth and building up a stock portfolio or index funds and whatnot, dollar cost average your way in. Don't listen to these fear mongerers. Don't listen to the people that are trying to scare you into giving. And don't listen to people that are trying to scare you into giving them your cash. Support the people that have your best interest in mind. Support the people that are in the same boat as you. Regular average Joes trying to improve their financial well-being. Support the people that share their tips and tricks, the people that share their successes and failures, show you what to do, show you what not to do. Support those people. There's so many people like that. Disregard the fear mongerers, disregard the people that lie and make the same nonsensical predictions every year. So, some of them even do it multiple times a year. Oh, it's going to happen. It's going to happen in the next quarter. It's going to happen in the third quarter of the new year. Third quarter. Oh, it's going to happen in the fourth quarter of this year. And that's where, oh no, it's going to be the second quarter of next year. You know, it's those people chasing fear. Anyway, those are just some of my thoughts. Went on a bit of a rant there. Is what it is. But just think in a logical way and listen to people that take a logical approach. Don't listen to people that take an emotional approach. Don't listen to people that lead with fear, lead with anger, lead with, you know, like vengefulness. People that are afraid of certain things happening. Don't listen to people like that. Listen to people that think logically. Listen to people that have an objective stance on what's going on. They evaluate what's going on. They reassess when necessary. They re-strategize when necessary. And try to make the most logical decision. They try to be as well-rounded as possible. Listen to people like that. Those are the people that I like to listen to. People that are objective, logical, focus on money, not fear. But I want you guys to head on down in the comments and let me know. Have you ever tried to time the market? I've seen it happen over and over and over again. Typically doesn't work. In certain circumstances it can work, but luck plays a role there. Not really a great deal of strategy. You know, I've seen people be like, oh yeah, I bought in when it was 10%. You know, I got that 10% back, and then I sold it, you know, when we were up, you know, 15%, and then they sold her, you know, on top of the world. They're like, yeah, I bought low and I sold high, and then as soon as they sell, it went even higher. Which, yeah, they still won. But they could have won even more just by holding on. Nothing wrong with selling on the way up to the top. You know, if there's 100 stairs and you cash out on, you know, step number 80, you won massively. But you would have won even more if you went up another 20 stairs. But here's the problem. You don't know if there are another 20 stairs. You might make it to 80, and maybe that is the top. Maybe you were like, you know, let me hold on, let me get to 90. And then you fall back down to 60. There's no real, true, honest way of knowing for an absolute fact what's going to happen, which is why I said at the beginning, and I'll say here again at the end, the best possible move to make: regular contributions. Regular, consistent investments over a prolonged period of time allow the compound effect, the snowball effect, to do its thing, and that right there is the winner's game. Because when it comes to broad market index funds, over a 20-year window, there hasn't been any losing to date. If you go with individual stocks, there's no guarantee that you'll be up in 20 years, because there are stocks that were booming 20 years ago and don't even exist today. There are companies that were explosive 20 years ago that no longer are in existence. Broad market index funds, on the other hand, is it guaranteed that you'll be up 20 years from now? No, but there hasn't been an instance where 20 years have gone by in the S&P where anyone has lost. It hasn't happened. Could it happen at some point in the future? It could. But if you want to listen to history, a lot of people say, oh, history repeats itself. But then when it comes to this, you're like, oh yeah, except for that. This time it's different. That's my favorite thing in the world. When people say that, oh, this is going on right now, we will never, ever be able to recover from this. Like, yeah, we will. Market crashes and economic retractions happen, you know, they happen. And we bounce back. They were like, no, not this time. This time it's different. Yeah, you said that last time, though. You said that last time we crashed and recovered. And guess what? You're going to say it next time, too. That's why I said, don't listen to the emotional people. Don't listen to emotional train wrecks. Listen to people who lead with logic, lead with being objective, taking a rational stance. That's where I'll end this video. If you guys like today's video, please hit that like button. Subscribe if you are new. Subscribe to my second channel, which is my backup channel, for exclusive weekly or bonus content. Get yourself some DYDSS merchandise to help support the channel in the biggest possible way. Try out some G Fuel, or should I say Tree Fuel. $5 off your first order by clicking the link in the description. Over 50 different flavors to choose from. This one's Bahama Mama. It's up there in my top 5, probably even my top 3. It's a delicious flavor, perfect for summer. Sugar-free, low-calorie, packed with a whole bunch of vitamins, and it tastes really, really good. $5 off your first order by clicking the link in the description. And of course, last but certainly not least, make sure to go and get your up to 12 free fractional shares by downloading Webull and funding your account. Doesn't matter how much you contribute, even as little as a penny. Still works, still counts. You still get your up to 12 free fractional shares, and they have a promo going on where as soon as you click the activate button, a 48-hour timer will start, and you have 48 hours to refer one friend. Easy peasy. One person that you know, just send them the referral link. And they're going to give you 18 free stocks for the referral, which you can keep and hold on to, or you can sell and use the cash to buy something that you'd rather have instead. Do not pass up on an opportunity. Webull link in the description. Everything will be linked in the description. And I want you guys to head on down to the comments and let me know one more time. What are your thoughts on everything shared in today's video? This was kind of broken up. This was supposed to be broken up into 2 parts, ended up broken up into 3. So number 1, have you ever tried to time the market? Is it something that you've done? Maybe you learned your lesson. Maybe you had one of those lucky instances where you succeeded. Have you ever timed the market, or do you plan on timing the market in the future? 2, are you preparing yourself for the almost every single year September effect? Are you doing what I'm doing? Are you doing something different? Maybe you completely disregard the September effect and you want nothing to do with it. You're like, September's just like any other month. I treat all 12 months exactly the same. And then of course 3, when it comes to the fear-mongerers, are those the people that you listen to? Do you allow people to drill fear and panic into your head, which change your ability to make rational decisions? They put all these terrible, horrible things in your mind to scare you out of your dollar, so you give your dollars to them. A lot of people out there try to scare you into giving dollars. Oh, you could buy all my stock investment courses. I'll teach you the way. You're gonna go broke if you don't buy my stock investing courses. Then you give them money for the stock investing courses, and yeah, you learn something from it, but guess what they do? They take those dollars and buy real estate. Just like the people who, try to scare you into, you know, buying their silver. Oh, you're not going to survive without silver. I have a whole bunch of silver and I'm trying to sell all of it to you. And then you give them the dollars for the silver, and then they go and buy stocks. Don't listen to these people. I don't listen to these people. Do you let people like that drill nonsense into your mind? Or do you prefer to take the logical, rational, objective approach? Head on down to the comments and let me know anything and everything related to today's video topic. Thank you guys so much for watching. See you next time. Don't you dare stop smiling. Peace.